go. So hello, everyone. Welcome to All In on Real Estate. I'm your host, Aaron Goins. I started this meetup because when I was in the military, no one in my circles talked about real estate. A lot of times we talked about debt and other finances, but nothing about real estate. I want to start a meetup where people can learn and educate themselves about the riches of real estate so they can start building generational wealth for them and their families. I'm very, very excited to have one of the main audience members, and the guy who in the after party is always showing out knowledge. Finally got him as a guest speaker, Mr. Lee Johnson. How you doing, Lee?
Welcome, brother. As I mispronounced the name the last time, Kayan. She says, "Grand evening to everyone." Kayan, did I get it right?
Yes, Kayan. Yes, you did. Kayan, grand evening.
You brought some Erica Badu to us.
Yeah, no doubt, no doubt. So I'm excited, man. I'm excited to jump into this. So let me ask you a question, like I always ask everybody else, man. How did you get started into real estate?
I'm going to show you my age, right? But I started in real estate by being up late at night, not wanting to go to sleep, and watching Carlton Sheets infomercials on TV. And when I finally had up enough money, like I had a summer job, I went and bought his his cassette courses. You remember that, right? So I bought those cassette tapes, and I tried to figure out if I was ever going to be able to buy houses with no money down. And I lived in Jersey City, New Jersey, and it wasn't happening. Not there, at least. And that was before the internet where you could splash, and I wasn't going to basically put an article into the newspaper to advertise because I didn't have any money. And walking around any urban environment, you see a lot of broken down houses, but you just don't know how to contact the owner or do things like that. So my first investment property that I purchased was in 2024. Crashed and burned in 2008. Got back on my feet in say 2012, and since then it's been a journey.
It's awesome. So you talked about the crash and burn. What was the biggest experience? What was your big aha moment for you during that journey?
Well, you always are able to recover from whatever instance that you run into. But, one of the things that you probably heard me say several times over is make sure that if you're going to do business with anyone, probably besides your spouse, make sure that you set it up as though it's a business, right? So you create your entity, you have your operating agreement, all of the T's and C's are defined, right? Because when things are good, everybody's happy, right? You have those documents for times when things aren't going so well, and that's going to define out how the business is going to operate. So I got into business with some family members. Not to say be careful, but if you're going to get into business with family members, sometimes it can have an impact on the relationship and things like that. And if you're going to go into business with family members, I say the relationship of the family member is far more important than making any money. And you never want to lose time with a family member, because when you look at the amount of time that we have on this earth, it's short when you think about it. So you don't want 1 day, 2 days, even 5 years to be lost on having business and finances come in between the relationship.
Absolutely. So I think it's a good point about family members and things like that. You got to be careful. And sometimes a lot of people separate business from family because of these things or lessons learned from others. When you first got started, what was your biggest, what was your biggest learning curve for you? Was it just education itself? Was it, you didn't know what niche to get into? What was the biggest learning curve for you?
Well, the biggest learning curve was paralysis by analysis, where you are and I wouldn't say the biggest fear was paralysis analysis. The biggest fear was going and doing things where I didn't have a full understanding and grasp of how to make it work, right? So going and getting a mortgage on an investment property, right, that was 2 hours away from me was something that I was a little bit afraid of. And that's one of the reasons why I probably did it with family members, right? But also, yeah, just not having confidence in myself that it would be okay even if things went wrong, right? Because one of the things that people talk about when they're investing is the fear of losing out. And you've heard me say before, the first principle that you have when it comes to investing is preservation of capital, right? Preservation of capital is the first thing that you have to do, because without capital, you are no longer in the game. And I've been fortunate to get back into the game, right? The only reason why after 2009 that I stood out the game for so long was because my work took me to South Africa, where I lived for 2 years, 2.5 years. And then we left and we went to Singapore for about another 1.5 years. And then we came to Seattle. I lived over in Issaquah, Washington for give or take 15 months, helping Costco to implement their SAP solution over there before I finally landed back in Virginia. And that's when I said, well, over that 5-year period, I made a ton of money and I wanted to put it to work. So that's when I decided to get back into real estate, doing a whole bunch of flips. Started to realize that flipping is a really bad thing to do if you have a high salary. Because when you flip, it's taxed as a capital gains, right? Short-term capital gains, to be perfectly honest with you. So it's taxed at that level, which is always a concern. So if you want to do a flip, in my first flip, I made $43,000, right? With that first flip, I probably paid $30,000 to, no, I would say probably $20,000 to Uncle Sam. So you got to ask yourself the question of, why am I going to do this work, take on all of this risk for me to basically share that money with Uncle Sam? Uncle Sam became my major partner in that deal at that point in time. So when I started to realize that fixing and flipping wasn't going to work, I started to do wholesaling, right? Wholesaling is another job, right? You got to work to be a wholesaler. You have to have a marketing engine and keeping those deals coming in. 1 month without a deal means that there's no income coming in. And finally, because I do have a high salary, I said, well, let me buy an asset where I can then do depreciation and amortization. And that's why I was looking for an apartment complex to purchase, right? However, purchasing that complex in my area, like right now in the Washington, D.C. metro area, you're buying a multifamily asset at about $250,000 to $325,000 a door. Why should I pay that much money when I can invest in Texas or North Carolina or Florida or any of those other places rather than investing locally? That's when I found syndications, and I probably found syndications 2017, 2018, dove in with both feet. At this point in time, I'm invested in 23 syndications. Some of them have started to turn from last year. We actually have 4 syndications that are under contract and are going to be selling. If there's an opportunity there, excuse me, I'm going to 1031 all of that money because I don't want to have to deal with the tax situation right now. But half of that, I would say 3/4 of that, is invested through my self-directed IRA. So I don't really have to worry about the taxes. But for any of the income any of the investments that I made with my personal funds, I'm worried about that because the taxes is going to be a problem when I move into it.
That's cool right there. I love how you traveled around, and I definitely want to ask you a couple more real estate questions for opening for the attendees to ask. But how was your experience in South Africa? What did you learn? What was the biggest learning lesson you learned? And just because you paint a picture as well about life in South Africa compared to life in the US.
Well, it's a third world nation. The infrastructure that we have here, like, we have high speed internet. When I was there in 2010, and mind you, I was supposed to go to South Africa for 6 months. I'm an SAP SME. I was going to go there for 6 months, help them to upgrade their SAP solutions, and I was going to be out. And the reason why I chose South Africa was 2010, the World Cup was in South Africa. So I said, yeah, fly down there, have a good time, do what I need to do, get out. But when I got there, they transitioned that project from an upgrade to a re-implementation. And that's why I was there for 2 years. The real difference, I just think one of the differences is that lots of people have stereotypes as to what it is to be American. I had stereotypes as what it was to be in Africa, right? So just getting to know the people is, I think, the biggest revelation from being over there as a whole.
Yeah, that's pretty cool. I was in South Africa. I was in South Korea for the World Cup back in 2002. So that was pretty cool just to be down there and be around. Actually, no, that was 2001. Yep. So that was some fun times right there. Fun times, man. So let's fast forward, man. And let's move forward to now. What is your goals now, and what is your challenges with that? So what's your goals and what are the challenges for to achieve your goals?
I read an article the other day, is that a salary is similar to crack cocaine. And I sent the email to my wife, right? And we both work from home. She rushed downstairs and she was asking me, what is this I'm talking about, crack? So that was pretty funny, but I met my wife in Botswana, right? So that was pretty funny. But the income is like crack cocaine in the fact that you don't want to leave it, right? If somebody's going to give you a couple hundred, not give you, at this point in time, I'm trading hours for dollars, but if somebody's going to give me a couple $100,000, right, then do I walk away from that? But in me being still in the business, I'm trading time for dollars, and I am splitting my time between my business and my professional career. Mm-hmm. So earlier I was just mentioning that in order for me to switch out, I have to replace my active income with my passive income, right? And that's why I'm focused now on basically being the lead sponsor in acquiring my own deals, right? And I believe that eventually I will get to a point where I can do 4 deals a year. And my capital raising arm of my business is going to be something that I leverage with other partners in between me shopping my own deal.
How big units are you looking for?
Well, my business partner and I, we just did a deal in Texas that was 460 doors, but that was the largest deal that she did and I participated in. But last year she did almost 900 doors. and that 460 unit was the largest of them. Right now, I'm in 23 syndications. So if you were to quote, air quotes, my portfolio is over 3,000 doors, of which I own an ownership interest in, but I really count the ones where I'm a GP, and the ones where I'm a GP, it's probably about 700 doors where I'm on the GP team.
So what has been your experiences? Let's start with passive first. What is the what have been your experiences of being a passive investor? Did you have you, with your experience being a passive investor, has that led to you being a GP, or you just have it's just been organic you being a GP?
No, I think one of the best pieces of my story is the fact that I've had to read so many PPMs to make these investments. And what I've realized is that there's a business that can be put together, because most of the syndications that are there require a $50,000 investment, right? So how is it that a person gets over that chasm of wiring $50,000 to someone who they do not know? That was one of the biggest hurdles that I had to overcome. My first syndication, I believe the real reason why I did it was because they were within my circle of trust, right? So there was a syndication group that from the local RIAs that I attend, they were there, and I knew them for 1 or 2 years, and I sent them $100,000. But when I did it, I had actually taken the check, and we met at a Panera Bread, and I looked her in her eyes, and I was like, I'm giving you 100 grand. Make sure that this comes back to me. And lo and behold, that property right now is in Georgia. It's on my website. It's been running at about 90s, high 90s, 96, 97% occupancy. And it hasn't been because we haven't raised the rents, right? Every turn right now, I think we're about $150 more than we had forecasted in the budget, right? So that's pretty good return, especially in this market. And I feel as though that's going to be the one that sells. And when it does sell, I'm thinking that we're probably going to get about at least a 2x equity multiple on that deal when it does close. So that's $100,000 right now in cash flow distributions. They probably already sent me about $20,000. By the time it sells, that's going to be my $100,000 back plus another $100,000. So all of that money is now going to go back into another deal, and we're going to do it all over again. So the one thing that I feel about investing in multifamily syndications is the fact that you can do this until the day you die, right? But a component of my business is not just syndications. I also think about wealth strategies. So you guys may know about infinite banking, velocity banking, privatized banking. That's another arm of my business that I'm building right now. We should probably be ready to go in late, I would say late April, early May. But the other part of my business is, as I set up my business, I did a lot of things wrong, right? So that experience that I have in setting up a small business is something that I believe I'll be able to sell as a service, right? Like working with Dala in the whole setting up your business credit, right? Too often people are using their personal credit in order to fund their business. That's the wrong way to do it. Don't do that, right? Learn from my lessons and go out, set up your entity, get the EIN number, start building out that vendor credit, and then you get those credit lines. But if I teach people how to do that, immediately those business partners who I work with, they have access to lines of credits that are at $100, $150, $200,000, and they can use those funds to be GP partners, right? Because you can take down a $5 million deal, $10 million deal. All you need to do is raise $2 million.
So I'm going to ask you just a couple more questions, but how did you feel? I know you looked at GP in her eyes and gave her the check, but how did you feel internally about giving $100,000 to her? And what can you give people at ease that are great, probably do the same process, maybe getting to their first deal, being a passive investor? What kind of advice can you give to them?
Well, whenever it comes to investing in syndications, you have to know the operator. You have to know their track record, right? You have to do your research. You have to, if you can, you have to underwrite the deal, right? You have to get referrals. But if you're underwriting a deal, you have to know what it is that you're looking for out of that. So I've always approached this business as, if I am the lead sponsor, right, these are the things that I'm looking for in a deal. Remember, I went through 18 of these things before I actually got access to the GP, right? So I know what I'm looking for in a deal, and I know how to fudge the numbers and all of those different types of things, right? Like, for instance, I don't invest in any deal that is not offering a preferred return. If it doesn't have a preferred return, I'm passing on it. Why? I'm passing on that deal because that deal is not investor centric. I believe that the LP investors are what makes this work. And if I'm not protecting them first, they're not getting paid first, then the deal is not balanced in the investor's favor. The grand scheme or the bargain that you make with the operator is that they get paid first, I get paid when I perform. So if there's no preferred return, I walk away.
Makes sense. That makes sense. Okay, so let's talk about being a GP. You say you have over 400 doors. What kind of experience is it for you that underwriting? So you underwrite all your deals, right?
Every single one.
Okay. What has been your experiences, and what is your big no? I'm not going to go this way for a deal.
Well, the first one is whether or not if it's investor friendly, right? But also what is going to be the split, right? I like to work on deals where you don't have all of these waterfalls, right? If we hit 20%, it splits from 70-30 to 60-40. If we do 22% IRR, it splits to 50-50 above that, right? Because it's investor centric. Investors are what makes these deals happen. Have a 70-30 all the way. If you win, they win, everybody wins, right? Because the sponsor is going to be making their money off of the fees. Right? There's the acquisition fee, there's the refinance fee, there's a construction fee. You could have an asset management fee, you could have a disposition fee. All of these fees are there. That's how the operator is going to make their money. So why do I need to make more money at disposition just because we did well? Everyone should benefit. And my belief is that if I perform for an investor, they're going to continue to come back. In my business, the best form of advertisement is a referral, right? So if people refer and say, Lee knows what he's doing, right? When I go down to the property, I take pictures, I'm there. So a lot of investors, they're sending money to people and they don't know if that property is really real. I take a picture in front of the monument sign so that people know that I've been there. And a lot of that work, it takes about a week to underwrite a deal fully to make sure that it makes sense. But you also have to underwrite the MSA, you have to underwrite the submarket. There's so many pieces that you have to underwrite in order for this to work.
Um, okay, so what has been your main experiences with being a GP just once you get the deal? Has it been a moment that, you know, anything you could share with the audience about being a GP that you wish you knew beforehand?
Well, when you're the GP, you get to know everything that's happening, right? Right. On a monthly basis, the GP team is meeting. We're having a conversation about how things are going. We're into that report that the property manager is sharing with the team. And you get to know everything that goes on. And that only enhances my experience even more for when I take over control of a deal, right? I'm going to know exactly how it is to run. A lot of people don't really understand what asset management is all about. The asset manager is critical to the operator because that's the one who's going to be ensuring that the property manager is doing their job. The property manager is going to be there on a day-to-day basis. It's the asset manager who's going to be making sure that the property manager is doing what they need to do. So it's a very, very critical role when it comes to syndications. If you have a bad asset manager, bad things will go on for too long, and it might be something that can't be corrected if you had a good asset manager. You don't hear people talk about the asset manager.
That's true. That's true. That's very, very true. Yeah, you don't hear a lot of people talk about that on podcasts or anything like that. I don't hear nobody really talking about the asset manager. Why do you think that? Why do you think that that people don't talk about that more?
Because
It's not sexy or something like that, or
perfect. It's not sexy. Too often you want to see people who flash out, oh, I got so many doors. I would say the hardest part of this business is after you get the deal, right? Because it's 3 to 5 years of holding that deal, managing that deal, making sure that everything goes right, because you are the steward for your investors' money. And your only job is to make sure that you return that principal back to them, plus some earnings, right? That's not sexy. But that is the number one job that you have to do as a sponsor.
right, right, absolutely, absolutely. Give me one more question, David, and I'll open up for you. So what is your end goal? I know that you said that you have over 3,000 if you count your LPs and your GPs together. Is there a certain number you want to do? Is it you just want to build generational wealth for your family? Are you just going to keep it going, just keep on adding more properties for your resume? What is your end goal?
You remember the 1031 exchange is the best part of the tax code. And the gentleman who introduced it to me 4 or 5 years ago, he called it swap until you drop, right? So I can do real estate in this fashion until the day they put me in the ground. So why should I continue to worry about corporate America and politics and all of these different pieces when I can work for myself, build generational wealth, right? Work for myself, build generational wealth. And, people talk about the 5 freedoms. And I could have back the biggest freedom of all, because I could have all the money in the world, but if I don't have any time, what's the sense? And I can have back one of my 5 freedoms, which is time freedom, to spend my day and live my life as I choose. That to me is the ultimate embodiment of what freedom is. But freedom has to be defined at the individual level, what it is that values to them. I keep telling people, I don't love real estate. What's the matter? I don't love real estate. I love the outcomes from real estate. That's what I love about real estate. I love the outcomes and what real estate brings to me and my family, etc. I don't like real estate. Real estate is a vehicle to get me to a level that I'm looking for.
Makes sense to me. Makes sense to me. I'm gonna open up to the attendees to ask questions. Please raise your
I
hand.
had a presentation.
Oh, you got it. Oh, my bad. My bad. Give us a minute, David. Go ahead and show that presentation. I forgot. You know what? You all talk about this.
Hey, I don't know. We're 7:36. David, come on, ask me a question. Let me know what you got.
You got unmute, David. You got unmute.
Okay. Real quickly, we're talking about a lot of different roles in the syndications, and I'm kind of curious. We talked about sponsor, you talked about the operator, you talked about the asset manager, you talked about the property manager, and general partners and limited partners, LPs and GPs.
Yes.
Question is, in the syndications that you are involved with, what is the typical makeup of a syndication or of a project that the syndication is investing in terms of who the people are, in what role, and on the management team?
Well, the sponsor team I have seen success be around a sponsor team having 3 individuals there, right? One person is going to be working with investors for investor relations, and that they're going to raise the capital. Another person is going to be on the team, and they're there for sourcing the deal. Finding deals is very hard. It's a full-time job, and it's a skill that if you have it, you can make a lot of money. Then the 3 legs of the stool is going to be someone who can look after the property and probably has a construction background, because I only invest in value add. I don't do core plus, and I really don't do opportunistic, right? I don't believe that I'm going to put my money out for 3 years and then start getting returns. What I like about value add is the fact that I get money the next month or next quarter after giving out my proceeds. Make sense? David, good?
Yeah, you got it. You got it. You got it.
Yeah, thank you.
No, happy to share. Do you want me to go through this presentation?
Yes, please. We got time.
All right. What I'm going to do is I'm always here every Thursday, right? So, this is not a one and done type of deal. Aaron and Laddie actually showed me how to do this. So I returned the favor because I really like the after parties. The after parties are the most fun for me because I get to joke up with people who are from New York and places like that. Can I share? All right, there we go. So my whole thing is about building generational wealth, right? And the biggest problem for me is the fact that I have my MBA, I have college degree. No one ever really taught me how to go about building wealth, right? Basically, they taught me how to make money, but making money is only going to get me into a higher tax bracket. And with that higher tax bracket, right, I'm going to pay more money to Uncle Sam. So I believe in what Tom Wheelwright says in Tax-Free Wealth, is that the tax code is only about 30 pages of how they're going to tax you. And right now it's about, in the United States at least, I know Chantel is on in Canada, it might be a little bit different. The tax code is about 6,000 pages. About 30 pages of that is written on how to tax you. The rest of the tax code is written on how you can find avenues in order to be able to save on money, right? So if you have that understanding, and that is the foundation for the basis of your knowledge, you'll figure out how to use the tax code in order to be able to give Uncle Sam what he deserves and nothing more. I'm a citizen. All of this stuff needs to be paid for. I'm going to pay as much as I need to pay and not a dime more. All right, so my company is called Value Investment Partners. And the reason why I called it value investment partners is because my goal is to deliver value and value alone, right? And if I can do that, you would be my partner. And every time when you go into something that they want to call special, they call it VIP. So our focus is on multifamily rentals, revitalizing and transforming communities. This is me, as I mentioned, when we wrote this about a year ago, we were at about 2,800 doors, right? And of course, when you're in a syndication, depending on how you come in at 50,000 or 100,000, that's going to give you a 1%, 1.5% interest in the whole entire entity. But that 1%, if you put it onto your schedule of real estate owned, that means that you have a significant net worth, right? Total value of all of that is about $334 million. And if I own 1% of that, that's $3.4 million. So this is a way that you can actually get your balance sheet up pretty quickly, right? And also I say, I was an investor first, so I understand how it is that an investor should be treated when it comes to investments, right? I know what good looks like. I know what bad looks like. I know what syndicators I would recommend, and I know what syndicators I would avoid. That's what happens when you've invested in 23 syndications. All right. I normally start off with this disclaimer, but this disclaimer is to say that if you're going to move into any type of financial investment, I can't be your accountant, advisor, or your attorney. I would say that you have to go and find someone who you trust, right? And can give you guidance as you're making that financial decision. My experience is different from everyone else's experience. So always consult with your own financial professional before you make any financial decisions. What I wanted to talk about is what is a multifamily syndication, and I think many of you understand that, so we will gloss over that, right? How you can invest, who can invest, right? Investing through a self-directed IRA. Why I really like the self-directed IRA is because nowadays, no one works at a job for 30, 40 years, right? The average, I believe right now is about 5.5 years. If you're investing inside of your 401k at your current employer, when you leave, you can take control of those funds and move them somewhere else. I say trust in yourself and go make that bet on you. Why use a self-directed IRA? And I have a case against mutual funds and 401ks. And then I'm going to run you through a scenario and how I personally have invested. Right? To the gentleman's question, what, and this is running inside of Google, so that it's off just a little bit, but what are the roles and responsibilities that you have there for the general partner versus the limited partner, right? The general partner manages the property, they find the deal, they put it under contract, they do the due diligence, they work with the investors, right? They are responsible for that. And for doing so, they basically take a small share of the profits. And as I mentioned, I like a 70-30 split, right? Sometimes you see 80-20, but a lot of the times you see 65-35, and then they have a waterfall depending upon how the asset is performing. And then they would share in distributions above those percentages. The passive investors are where I believe all of this happens. You do not do group investments, which is a syndication, without limited partners, right? But the limited partner doesn't have to worry about tenants. They don't have to worry about code violations, right? The bargain that you give as a limited partner is that you give money, whatever they promised you, and as a return, hopefully they can keep their promises, right? Right now, as I mentioned, VIP only invests in deals with as a preferred return. I remember 2 or 3 years ago, there was a gentleman who told me that they weren't offering a preferred return because the property was going to do so well, right? The preferred return says that I get paid before the sponsor gets paid, right? I wanted to make sure that I got paid before they got paid. So I didn't invest in that deal. And it's a principle that I have stuck with for the majority of my investing career. Now, when it comes to investing in syndications, there's two ways to do this. You can do this in personal funds and you can use retirement funds, right? Personal funds, when it's distributed, that's going to come into your personal income, right? So it's going to rise and fall, right? And there's a whole bunch of things that we could get into, whether or not if you can deduct passive losses against active income, yada, 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 right? If you are a real estate professional and have material participation, you can group all of the assets into one and you can carry those losses in current year. When you have your stranded 401ks or previous 401ks, that's where you're using retirement funds. And I'm reading the book called Eqrp because there are differences between self-directed IRAs and Eqrps that make a difference. And I might be switching over once I complete the book because there are some advantages to using a QRP that I see, right, that I need to think about exploring. And understanding, I might be giving you a lot of information and I always want this to be as interactive as possible. So don't hesitate to raise your hand. I'm more than happy to answer any questions that are there. Now, when you're working inside of syndications, you guys probably always hear, what's a 506B versus a 506C, right? Here is what it is. 506Cs can only allow investors who are accredited to invest in the deal. And by accredited, as a single individual, you have to have an income for the last 2 years of $200,000, right? Or as a couple, $300,000, right? Or you have a net worth of $1 million, not inclusive of your primary residence, right? Those with established clear measures of financial sophistication can qualify under the sophisticated title that they aren't accredited, but they have the means to say that they're sophisticated. And now 506Bs allow for non-accredited / sophisticated investors to come in, but they're limited to about 35 is the number that I have in my head. So sophisticated investors do not meet the accredited environment investor requirements, but have knowledge and experience in financing and business matters, therefore capable of evaluating merits and risk and prospective investments. So whenever you are going to come into a syndication, there's something called the PPM, which is the private placement memorandum, which is typically 100 pages or more. You have to sign a subscriber's agreement that says what you are, right? And all of this gets filed with the SEC. So all of this falls into that one little sliver of law that is managed by the SEC. And a lot of people don't know this, but there's an SEC at the state level and there's an SEC at the federal level. One of the things about the SEC is that they're self-funding from fines. So they don't get any money from the government. They get money from the people who they fine. So they typically like to come after people when they have them there. All right. So when you have your self-directed IRA, what can you invest in, right? You can invest in real estate, which is what I'm doing, all right? You can invest in commodities, precious metals, gold, silver, private loans, tax liens. You could even invest in Bitcoin if you wanted to. I wouldn't do it, but if that's what floats your boat, go ahead and do it, right? The rules to follow: follow proper setup processes and find out tax implications. One of the reasons why I'm exploring going with an Eqrp is the Eqrp doesn't have UBIT, which is unrelated business income tax, or and there's UFDI, unfinanced debt. But there's two terms that you have to be familiar with, right? But whenever leverage is used with a retirement account, there are tax consequences for doing so. From what I have read thus far, when you have an Eqrp, you don't have to worry about the taxes. When there's a self-directed IRA, you do. So that's one of the reasons why I am exploring whether or not if I'm going to transfer my self-directed IRA to a QRP. There are prohibited transactions when you are investing using a self-directed IRA, and it's around art, general partnerships, S corporations, private corporations that employ you or your spouse. So there's rules about who you can invest with. There's restrictions about investing above you, your mother, your father, and your children below you. Your grandchildren, you probably can get away with that. But those are certain restrictions that you want to make sure of. Otherwise, it breaches this, and no longer do you have the tax consequences of it being an IRA. So there's a lot of good information about that. And if you need advice as to who am I using and things of that sort, I could always give you advice on that offline. But of course, you have to do your own due diligence and go forward from there. Right, so how do you set up a self-directed IRA? You can take IRA funds from somewhere else and you can move it into your SD IRA, or you can take 401ks, and that's primarily my avatar, is because I'm working with technology professionals just like myself, who typically move jobs every 3 years, and to take those stranded 401ks and move it into a self-directed IRA. I tell people, if you trust yourself, go with a checkbook IRA. That way you don't have to go to the custodian whenever you want to make an investment. All you have to do is write a check or wire the funds. It's a lot more control. But if you don't trust yourself and you are inclined to use some of the money for other things unrelated to investing, I say go with the custodian, right? But the model that I'm going to give to you is, okay, you trust yourself, so why not create a new LLC, right? And then that LLC, which is what you control, yeah, there's still the custodian and you have to report to them the assets that you've acquired. But now you are in control of using those retirement monies, right? And don't have to invest in mutual funds, because mutual funds have a whole lot of fees that people don't realize. But you can invest in real estate. You can do hard money loans, or you could invest in things like Bitcoin, like I had mentioned to you all before. There's a number of different things. I say, bet on yourself. Don't bet on the guy on Wall Street, bet on yourself. Okay, why I don't like mutual funds is all of the fees that you see there. At least when it comes to a syndication, the PPM calls out the fees that the operator is going to charge, right? But a lot of people don't spend a lot of time looking through the prospectus to understand, well, what fees are there. Most people don't know that sometimes there's a load fee when you move into an actively managed fund. They'll charge you for the privilege of being in their fund. Go get that. There's a redemption fee. There's an exchange fee, because I still have my W-2 with Fidelity, with Dell Technologies. Every time I get paid, money moves into my 401k, there's this record keeping fee. And it's only $1, but that's eroding my investment potential. And that $1 that they're taking every 2 weeks is not being invested, which means that I might have to work another 2 years if that was the model that I was going to use. And then there are purchase fees, right? Just for moving into the investment. A lot of people don't look at this stuff. I look at it. I know that it is there. And the next example that I'm going to show you in a couple of slides is how those fees actually erode your earning potential over a number of years. The one that you're going to love is the 12B1 fee, right? and is paid out of the fund's asset to cover distribution expenses. I don't even know if many people know this, but the mutual fund companies charge you so that they can advertise for more customers. It's called the marketing fee. So all of these different fees are there and eroding your earning potential. That's why I say if you're going to invest in mutual funds, invest in index funds. They do what the market does. The fees are lower than if you were to move into actively managed funds. As a matter of fact, this book right here, I don't know if you guys can see it, but this is the Benjamin Graham book. And this is the guy who actually taught Warren Buffett how to trade. And it's about at least 700 pages, 726 pages on how to go about investing. So little nerd stuff right there for you if you ever want to read it. It's the most boringest thing that you would ever touch. All right, but what I show here is these are the earning potential, right? If you were to have invested $100,000 over 20 years, this graph shows you in green is where you would land if it's at a 1%, if you had an annual return. So this is like investing in bonds, and the annual fee was just 1%, you'll land at about $180,000, right? If the annual fee is reduced in half to 0.5, you'll land at just under $200,000. And if you were able to find a fund where you would be at 1.25, which you can get away with an index fund, you're going to land at just south of $210,000. And I think because most people's career, if you're going to stay in the W-2 land, is over a 30-year period, but this shows you what happens over that time. So literally there's a $40,000 difference, right, after 20 years, and most people are working 40 years, right? There's a spread of about $80,000 if you were to project this out over 40 years. And this is one of the reasons why I say people should bet on themselves versus betting on the mutual fund company, because guess what? If you follow the strategy that I have, you're going to basically be able to get 7 or 8% per year cash on cash return. Why would you give these guys your money? It just doesn't make sense to me. So I chose not to give them money. I chose to read books and educate myself on what's needed to be done there. Aaron, I see there's a question in the chat. Does anyone want me to stop?
Yeah, anybody can ask questions. So whoever wants to talk to lead, please do. And we can go from there. So
because I'm in presentation mode, I can't see what the chat is.
No one, I don't see a question in the chat yet.
All right, cool. Let's keep going then.
Well, I had a question a moment ago.
Okay.
Go ahead, David.
So real quickly, you talked about an Eqrp type of retirement fund. What does that stand for? I haven't heard it before.
Well, the QRP stands for Qualified Retirement Plan, right? The E is just for enhanced. So the book that I'm reading is by Damien Lippo. Is either Lupo or Lipo, and they shared the book with me, and I've been reading it because I was on Aaron's call or Laddie's call a couple of weeks ago, and Parker was there, and Parker worked with them, and I told them, hey, I'm all over this self-directed IRA, and he shared with me the book because I had it, but I couldn't find it, and I started reading it because I wanted to see, well, what is it all about? Because a lot of the people who I talk to, I say self-directed IRA is what I would have directed them to before. But when I understand their scenario, I might be able to direct them to a QRP versus going the self-directed IRA route.
Thanks a lot.
All right. So here, when you have an investment and if you've ever invested or wrote a deal, this is what you're going to see, right? This is what is going to pay out cash returns on your distributions in year 1, year 2, year 3, year 4, year 5, right? And it tells you that, okay, in this one, there's not going to be any capital return from the refinance, but there's going to be a return of capital on the sale, right? And your total return is going to be $110,000, which is going to give you an overall cash on cash return of 110%, right? The return of original capital is going to be $100,000, right? So typically, this is what you're going to be seeing. And this is whether you're investing with your IRA funds or not. But these are the types of returns that you can guarantee yourself right now, because anywhere from late December to now, even today, the stock market lost 500 points today. I can guarantee you that on every single syndication that I'm invested in today, the rents are going up. Why? I don't know if you watch 60 Minutes, but recently on 60 Minutes, there was an economist, I don't know if she was with Zillow or whomever, but there's a shortage in America of about 4.5 million houses, right? And for those who can actually afford a house, guess what? They're being priced out. My wife's a realtor, and she wrote a contract for someone the other day. They lost the house. Someone had bid $35,000 over list for an asset. Really? So if you're an FHA or VA buyer, it's going to be hard for you to find a house, because the market, people are saying there's a lot of scrutiny for VA and FHA loans. I'm going to go with somebody who's conventional, and they'll ask to put in the contract that if the property doesn't appraise for what you wrote the contract for, that you can come in with the money between the difference, because the mortgage is not going to be able to go all the way up to what you decided to overpay. So they're going to want to see proof of funds that you have those monies available. But when you're looking at investing in syndications, the things you're going to be looking at is your investor return, 7.5% projected preferred return paid quarterly. That's one of the things that I told you about. If it's not there, I don't go. Looking at, I have a bar of my IRR and your AAR, right? Then you're also looking at your cash on cash return, right? Really, IRR is what matters to you, because it factors into it the time value of money, and that's something that you have to go into, because there's a discount rate that is associated with that. Hopefully that makes sense to you. All right, so when your scenario is there, how do you invest in a deal, right? Invest personally with a multifamily. You got to work with brokers. As I mentioned, you have to look at the MSA. Once you select the MSA, then you have to go and select your submarkets, right? So in Washington, D.C., there's about 14 different submarkets in the Washington, D.C. MSA, right? You have to put together a letter of intent. The letter of intent only is non-binding, but it says that this is what you believe that you will be able to pay for the property, but you want to do your due diligence. So once your LOI is accepted, you typically have a grace period for which you're going to have to then go through, do all your due diligence while you're working on your PSA. Your PSA is your purchase and sell agreement, and that's what locks you in. Once you have a finalized PSA, your money, your earnest money deposit goes hard. You don't get that back. You don't walk away from the deal. You're all in at that point in time. And now, because the market is so tight, people are going hard on their EMD during their letter of intent. That's how aggressive the market is. One of the things that you won't be able to get financing on a deal if the debt service coverage ratio is not greater than 1.25, right? How do you make money? Income minus expenses minus debt service equals cash flow. Whatever's left over can be distributed to the investors and the GPT. Commercial financing is something that you have to do. I don't invest in deals that have more leverage than 75%. Well, 25%. So if the coverage on that is greater than 75%, is too levered, I don't go into the deal. And also I do a sensitivity analysis on the deal, and I check the income that's coming in at 65% occupancy, 75% occupancy, 85% occupancy, because I want the property to be able to service its debt, even if the property went down to 65% occupancy. That way I'm covering myself and I'm covering my investors, and that's just something that I do. All right, so when you're investing personally, you have to do your due diligence, property condition report, market surveys, internal property condition assessment, financial documents and audit. Literally on the 460 unit, we had to walk every single unit. So we broke it up into teams and we parceled it out and we walked every single unit. You do that with your property manager so that you can take an inventory and know what's inside of each unit, so that you can put together your budget, so your business plan can be known. You have to do an environmental site assessment, an appraisal, a green report. These are all of the things that when you move out of single family rentals into commercial, this is where you have to have your risk capital so that you can pay for all of this stuff. People don't typically work for free. Your property manager may work for free. Your asset manager will probably help and do some things for free, but everyone else, your engineers, they have to get paid. Your surveys, all of that, they all have to get paid. And that's where your risk capital comes into play. All right, so in the scenario here, I live in Washington, DC area, right? So Arlington, Virginia, 14 units is at 4.5 million. This is the value C add, right? The down payment at 30% is going to be 1.3, right? The EMD is 1%, $45,000, a loan of 3.15 million. The repair budget is going to be 800,000, closing cost 2.4%, 108,000. So the total investor amount is going to be 5.4 million. And this is only on a 14 unit. And one of the primary reasons that I mentioned why I'm not doing deals at home, I'm doing deals away. Just because, as you can see, the price per door is going to be pretty significant if I was to invest at home. And I'm not that big of a deal yet. And hopefully I could invest at home eventually, but I'm not there yet. Aaron, we had a couple more questions inside of the chat. Can't hear you, bro. All right, I'm gonna keep moving. All right, so let's summarize. I know I gave you a lot. My details are in the chat, but I tend to say, like when I did my first flip, right? It was I think I might have purchased it for about 300,000. I still had to come to the table with about $70,000, $75,000 in order to secure that deal, because the hard money people were only going to give me 60 or 65%. Right, maybe even 70%. They will fund the renovation, but they're not going to give you the renovation money. They're going to set it up on a draw amount. And when it comes to hard money lending, they charge you points. So they want to give you 70% plus the renovation budget, because they get to charge you more on the point side of it, as well as the interest rate is going to be on that larger amount versus that small amount, even though it's lesser based off of the interest. So as a passive investor, you have to identify multifamily syndicators, understand their track record, right? Talk to other investors who have invested with them so that you get a feel. Decide on how you want to fund the opportunities. As I mentioned, you can use personal funds, you can use a self-directed IRA, 401k, etc. The one that I'm going to add to this is possibly you can use an Eqrp. You set up the IRA and you register that with a company. If you have any questions about how to do that, I've helped too many people set up their self-directed IRA, right? Personal portfolio, more of the same. Is do you want to do this in your individual name? Because then you're going to be giving away your social security number, right? Or do you want to set this up as an entity and then you give away the EIN number? I would say hold your social security number sacred, set up an entity, small, $50, $100 or whatever it is. And then that way your name and information is not on public record, right? Last but not least, always do your research before you start investing, right? I had to do my research and I help others with the research that I do, right? But last and all, I hope I didn't scare you. This is the absolute best way to make money. I've tried so many different things in so many different ways, and I'm hanging my hat on multifamily real estate and syndications, right? Because if you can do a syndication, you are in business. So happy investing. Any questions? All right. If there are no questions, here's my calendar. I'm a tech guy, right? I told you guys I graduated with a computer science degree. If you scan that QR code, guess what? It gives you all of my details. Or if you want, you can text me, meet up to 571-444-8474. You get into my CRM and then I'll communicate with you at that level. So thank you for your time. Here's my contact details. If you're not a techie, here are my details. Value Investment Partners is the company. We're located out of Virginia, and this is how you get in contact with us. All right.
So I did have a question just regarding the EQRP and the self-directed IRA. You had mentioned there were kind of things that you would suggest to people depending on their situation. But what are kind of some of like the general differences between the EQRP and the self-directed IRA? Because I've got a self-directed IRA, and I'm holding just a single property in that self-directed IRA. But as far as if I were to start a EQRP, what would be the differences and potential benefits that we might be looking at?
I'm over here. I'm just bringing up what UDFI. Well, first and foremost, when you set up an EQRP, you're setting that up because it's a 401k, it's a qualified retirement plan, right? So it's similar to what you have if you have a W-2, it's a retirement plan. When you set up the EQRP, it's there for all of the employees, right? So you as the employer, if you bring on employees eventually, because you have that qualified retirement plan there, the qualified retirement plan is applicable to all of the employees that you bring on as well. Some of the things that I like about the QRP is the fact that you are able to take up to a $50,000 loan from the QRP, right? So if you are needing money, just like how with your 401k, you can take a loan out from your 401k. From the QRP, you could take a loan. But the piece that I like the most about a QRP is that with the QRP, hold on, is that when you are investing in using leverage, right, you do not have to pay something called UDFI, right? And UDFI stands for unrelated debt finance income. Unrelated debt finance income, that basically says it doesn't want to give you an advantage for investing using retirement funds over someone who's using non-retirement funds, right? So when you have the QRP, you don't have to worry about UDFI, right? Whereas with the self-directed, you do. So that's going to eat into your returns just a little bit, right? But is it worth it? I would say, let me run through the scenarios and determine which one is the one that I want to use. Because right now I have everything in the self-directed IRA.
And the QRP distinct from the SEP IRA?
Yeah.
Okay.
Because a SEP is a self-employed IRA. So there are different constraints around that. just like there's different constraints around the solo 401k, et cetera. The book goes into all of that, but I'm really only looking at the plan where I would be able to set it up. But literally, you're setting up, you have to have a corporation, and the corporation then has to have the retirement plan, and there's going to be management fees around that. So when it comes to a self-directed IRA, my fees are about maybe $300 a year, right? So when I go into the QRP, if it's more than $300 a year, then I have to look at whether or not all of these scenarios that I'm thinking about make sense.
Gotcha. Appreciate it. Thanks.
All right, pleasure.
Go ahead, David.
I guess I've got a lot of questions today.
Yeah, that's why we're here. We're here to network and learn from each other's experiences.
And this is, first of all, I'm asking a lot of questions because I'm just kind of getting into this whole syndication thing.
Okay.
And so it's a bit confusing to me. But what I'm wondering about is are there already funded and set up syndications that are looking for properties to invest in?
Yeah, I understand your question. And most of the time, if there's something called a fund, you probably see people who are saying invest in my fund, and there's different kinds of funds. They're most likely going to either have you invest into a blind fund or a semi-blind fund, right? A blind fund that basically says, I'm going to invest your money in real estate. Doesn't have to say where, how, for how long, blah, blah, blah. That's a blind fund, right? There's a semi-blind fund that has more constraints around how they're going to invest the money. A lot of people have set up funds, I believe, is so that if they don't have a deal, they can still take in money from you so that when they find the deal, they can put it to work. They don't have to do a raise. They're constantly raising at that point. But then you have to read the PPM to understand, well, do they only start paying you interest, right, or preferred return once they secure a deal? Right? Because why should my money be with you versus with me? I could do something with it that you can't. Okay. Right? So you have to understand, but if you're investing in a syndication, you're going directly in. And typically there's one PPM, one LLC for the syndication. It's a one with the fund, you can invest depending on how the fund is set up in multiple deals.
Okay. So it's project. Typically, you invest in syndicates that are related to a specific property to take down a particular property.
Yeah.
Okay. My background is in architecture and development. So and not in business.
No,
so I find properties like the one behind me, which is a good for a custom single family home for somebody, and I see, well, what can this property become? Yeah. So that's kind of my where I excel. So, but my biggest bugaboo, I can find a property, I can see what it can become, but getting it funded, I've lost so many deals because I haven't got them funded. And so
the right team, right? Because like if you're doing the flip model or the B4R model, the money is easy. The money is the easiest part of the deal because I will always have access to a hard money lender who's going to give me the money. So I never worry about the deal if I'm doing a flip. I got to find the deal. I can find the money.
Well, I don't do flips. If it doesn't have a cash flow, a rental exit, I don't want any part of it.
Got it.
I've done flips and I've done rehabs and I've gotten in big trouble with them because of the short time frame.
Yeah, no. I saw you shaking your head when I was talking about capital gains and the income and all. Yeah, you can wave your hand. It's like when a lot of these folks get their deals, they say close. That's the easy part, right? Now, if you make $40,000, you got to keep at least 15 around because you don't know how Uncle Sam is going to tax you. So you can't really have fun because you're nervous so when I see people who say that they do 12, 15 flips a year, I say probably because they're self-employed, they have their employment at about $60,000, $70,000 so that they can take advantage of all of the capital gains at that point in time. That's the only way it would work. If you're over $100,000, it's not going to work.
Yeah.
It's definitely not going to work if you're over 100.
So I'm constantly finding properties that have, potential cash flow and that kind of stuff, and I'm learning how to underwrite those. But what I'm looking for is, I'm just wondering if there are syndications that are looking for deals to invest in, and how do I find those? How do I partner up with those to invest in a property, and as part of that sponsor group?
Well, the thing is, it really, when you put together a syndication, you have to put together a PPM, which means you have to work with a syndication attorney. That's something crazy going on over here.
But if there's a blind pool, can I not partner on a property in a blind pool, or assign to the blind pool the property?
It's just that in order to go and set up the fund, you're going to have to pay about $7,500 to $15,000 to set it up. And that's going to be your sunk cost, and you're probably never going to be able to make that back.
Right.
The fund has to have a defined start time and end time. And most people aren't going to give you their money for 10 or 15 years. Like I have some folks who are VC folks, and they tell you that they're going to 5x your money in 10 years, right? That's why you would give them money for 10 years, right? But if you were to go into a syndication, you can literally 2x your money every 3 to 5 years. So you have a return to get that money back and invest it again. And you can do that 5 to 6 that the venture capital people are telling you about. So I think that this is a much easier asset because a lot of those tech VC funds are investing in a company that can go belly up. Real estate, it doesn't really go belly up. You have to be almost like the village idiot to lose a lot of money.
Right.
Yeah.
Yeah, I understand that, but I'm not sure that I'm kind of getting the answer that I'm looking for. I'm coming up with projects and property.
I was
wondering how I can
a JV, a JV fund, a JV with other people, because
right.
if you do a JV, all you have to do is set up an LLC, do the operating agreement, and you're good to go there. You're not working with all of these monies that you're talking about for a syndication, SEC attorney, blah, blah, blah.
Right.
Just get a pool of investors, put together an entity, call out everything inside of the operating agreement. Good to go. That's going to cost more than $500.
Yeah, but would having a blind pool syndicator be a member of that LLC be a possible way to go?
I think you're blurring the terms. Why would I go with a blind fund, right? Because a blind fund requires me to work with SEC attorneys and do all of these different things.
Right, which is what I'm saying. I'm saying that if somebody has already gone to all that trouble and pooled money, but they're looking for the property to invest in, if I set up a property related LLC, and one of the members is the fund of funds, that syndicator, the money guy.
Well, how about this? My details are in the contact, right? Let's take this offline because it seems like it's more complex question,
Okay,
right? And then we can go from there.
all right.
All right.
Yeah, definitely, David. I'll definitely hook you guys up together. So that's not a problem. Jordan.
I guess one of the quick questions that I have for the PPMs, what are, I guess, like the top like 3 items? I know you had mentioned the preferred returns, but outside of that, what are the top 3 items in a PPM that you're gonna look for every time, or the first places that you go to?
The first place that I go to is sources and uses. The sources and uses tells you the capital that they're raising, how they intend to use it, right? I typically only like to invest in deals where the sponsor is putting capital in the deal, right? You want them to have skin in the game just like you, and I don't want the skin in the game to come from the fees that they collect. I want them to actually take money out of a bank and put it into the deal, right? And then you want to understand the structure of it. But the first thing that I'm always looking for is the sources and uses. And then I might go to the schedule to understand how they're going to pay back. Something called return on capital versus return of capital, right? So that's something that you want to look out for, because return of capital says that every distribution that they give you reduces your investment amount, whereas return on capital, if they return you capital, you're still in there at the level amount. So those are some things that you want to look out for.
Got you. And I guess Robert's got a question. I do have a question after him.
I was speaking with Robert yesterday, so he asked all his questions yesterday. What's up, Robert?
Hey Lee, what's going on? Good presentation. You know what I wanted to ask about? I know I heard about it in another syndication deal. At the very end, right? You get your distributions, you get your quarterlies, all that stuff. When they sell or refi, they're going to pay you your initial investment plus whatever, if it's 1 time, two times. How about that deal where I guess they call it infinite? You keep getting money if they don't sell the property and they refi it, and you stay on as, and I'm talking about LP, come in as an LP. What do they call that? And would I be able to find that language in a PPM where it just keeps going?
If it's not in the PPM, it's a lie. The PPM is the document that has to be filed with the SEC on everything that they spoke about. If it's not in the PPM, it's a lie, right? As you remember, I was saying return of capital versus return on capital, right? There's a major difference, because when you have return of capital, every distribution takes you a little bit out of the deal, right? So you have a return on capital where until they sell the asset, you're always going to be in.
And if they don't sell, if they don't sell, if they refi and it goes on beyond 5 years, what happens?
But the nature of this game is to sell, right? The nature of this game is to sell, because once you exhausted the depreciation and the cost segregation, you lose all of the tax benefits. So why be in it? You want to go back and do it all over again.
Okay. So, and this will happen at refi or at sell for you to get all your capital back.
No, they can return all of your capital at a refinance.
At refinance.
Yeah.
And then you're out, right? There's no more quarterly.
No, that's if it's a return of capital.
Okay.
Once they pay you back all your money, you're out. They get to keep the asset and go on with their business. Return on capital says We returned you some capital, but you're still in the game.
So that little word from
That
of the
little word makes all the difference, brother.
So Lee, thank you for the presentation. It's been really beautiful. I think what Robert is asking, if they return the initial investment and he still gets to get a PC, could be a percent or two. That might have to be negotiated in that PPM from the jump, I believe.
Negotiate the PPM, brother, unless you are bringing in a significant amount of capital. Once the PPM is set, it's set.
Yeah.
Yeah, some people keep the property and they continue to make money off of it. I think that's what Robert is trying to say.
That's return of capital. Once they've returned the capital that you've invested into the business, you're out. They can keep the property, do whatever they want to do with the property. That's why I'm saying return on capital versus return of capital has significant difference in how much you're going to make off of the deal.
And we can see it. What do they call that form, or when they're starting to raise capital, they put all the numbers together, and
That's an offering memorandum.
Yeah. Say that again.
The offering memorandum. We say, but the OM is only like a marketing brochure, right? The PPM is where everything has to be called out.
Yeah, all the
I can say whatever I want to say inside of my OM.
Yeah.
But I can't say whatever inside of the PPM. The PPM is like when you go to court and you lie, or you lie to the FBI agent. There are consequences for lying there. The OM can say anything. When you get the OM, it first thing says that we put this together based upon all of the information. It could be wrong. There's a disclaimer inside of every single offering memorandum that you see. I think Lawrence disagrees with me.
All right.
I apologize.
Sorry about Mr. National, man. I'm sorry, man.
I have a question. So hey. So my question is, going back to the self-directed IRA, right? So not a Roth, an IRA. You're saying if you put money into your self-directed IRA, you can take that money and then put it into real estate, right? So like a funnel, you would say?
Sorry?
Like a funnel, right? You get your earnings, you put it into a self-directed IRA, and then from the self-directed IRA, you put it into buying properties?
Yeah.
Now,
the thing about that is all of the money that you get from the investment have to go back into the self-directed IRA until you meet distribution requirements, 59.5, 72.5, blah, blah, blah.
Say that again, please.
So whenever it comes to retirement plans, you can't take the funds out of it without penalty until 59.5. Right? But a lot of people don't know that there's something called the RMD, which is required minimum distribution, which you have to start doing at age 70. 72.5, maybe, something like that. Don't hold me to it. Right? But when you're investing through the self-directed IRA, all of the proceeds go back into the self-directed IRA. You can't take money out. But with the QRP, as I mentioned to you, with the QRP, you can take a loan out from the retirement plan, similar to what you can do at your job with your 401k or 3B or whatever it is that you have at work. You can take a loan out against that.
But so I guess what I'm not understanding, so what about a Roth IRA, right? You could take money out of a Roth IRA to no.
Roth is what you put into retirement with after-tax money.
Yes.
Right? And you're not taxed on the gains.
Right.
Right. So that's the different trade-off that you're making, is that with the Roth, you're not taxed on the proceeds when you take it out because you use after-tax money to invest.
Mm-hmm.
But I would say that there are much better deals for you than going the Roth IRA route. We could talk offline if you wanted to.
Yes, if you could, I was trying to catch the Calendly link, but you switched the screen so fast. So at some point, maybe the after party, you can put it back up.
Well, and that's a great point right there. So look, we're going to go to the after party. So I just want to say thank you to Lee for all the information you share with everybody, answering all the questions, and really educating people so much, man. So I want to say thank you so much. I wanted to say next week, Angel Williams will be the guest speaker. Also, we just came up with a podcast with Billy Keels, the Going Long podcast. Check me and Billy out. We had a great conversation. Another thing is, Lee and others, we are part of the GOB network, and there's going to be a conference for the GOB in July. So more information, please contact me or other members of the GOB about that. And look, guys, I hope you see everybody next week. God bless you and take care.